With the stock market at all-time highs, what are the best value stocks to buy right now, and why should we be focused on value stocks to begin with? Let's go ahead and break it down. So when we talk about value stocks, these are basically companies that are worth X amount, but you are buying them for cheaper. So for example, buying $100 for just $50. Everybody would love to trade $50 and they get back $100, right? That is the goal in life, is to consistently do that. But when we're talking about the stock market, we're taking companies, evaluating them and say, look, I think it is worth X amount of dollars and I want to pay half of that. This entire investing strategy is what Warren Buffett has done. That is what has made him one of the richest people in the world and one of the best investors of all time. But the problem is this: when the stock market is as high as it is and is doing as well as it is harder and harder to find companies at great prices because everything feels inflated. For example, Nvidia. We did an entire video around how I multiplied my investments by 4, and a good chunk of that was because of Nvidia. Well, today, Nvidia is up 216% from where it was last year. I don't know if that's a discount at this point, right? We'll see what it does in the future, but it's hard to find good companies at even better prices. But I have found 4 that I think are definitely worth your time and worth you continuing your research and seeing if it makes sense on your watch list. So in no particular order, the first one here is the Pulte Group. You can pronounce these how you want, okay? The stock symbol here is PHM, and this is a company we've talked about inside Members Only. I've mentioned it at least one time on this channel before, and you should have listened, okay? So for one, I am valuing the company at about $119 per share. At the time we're doing this video, it is at $104 per share. So that spread, the gap between 104 and 119, it ain't that big. But right now, it is still, in my view, relatively underpriced. There's also a theme here on this list that started to emerge that I think is pretty interesting too. Right now, over the last 6 months, it's up 23% and is up 83% in the last year. Now, yes, I know, a company that's up 83% does not feel like a discount. This is why that gap right now is only, what, $15, okay? When I brought it up the first time, perhaps it was at a better discount. Just saying. I'm just saying. So it doesn't mean that when it hits 119 that the stock is just going to stop, okay? That's not what that means. It does mean it may not, be the best deal at that point. You could be overpaying for a stock, but I still think it's going to be good. This is a home building company, and we've noticed now over the last 3 weeks or so, outside of tech, manufacturing, home building, these companies tend to do quite well. I think a part of it, not a whole lot, but a part of it is because of the infrastructure bill, but also we have had a backlog of housing supply, right? We have not been able to really build as many homes as we wanted to. Inflation has come down to make home building a little more affordable. I think we're starting to see a boom in those spaces. I still think it's relatively early. I don't think the entire stock market has really caught on to this across the board. So this is me telling you now, all right? Second time, me telling you now. Next one here is Clinanese. Again, I pronounce however I want to pronounce it. The stock symbol here is CE. The company, I am valuing it, my price for it is about $160 per share. At the time we're doing this, it's only at $152. So the gap here is only $8 at this point in time. I promise you these gaps are going to get bigger. But right now it's slightly underpriced. What you might like the most is the fact that it is up 19% in the last 6 months and up 21% over the last year. Why would that be a nice thing? Why would that even be something worth looking at when the last stock you said was up 80 and Nvidia was up 200? Here's the thing, okay? There's no guarantee that because a company was up X amount, that's going to be up that very next amount the next year. Okay, I think we all know that at this point. However, it is less likely, at least to me, perhaps it's a bias, you let me know in the comments, but if a company is up 80% in 1 year, it is very unlikely that it's going to put up that high a number the very next year. It's hard to be realistic and look somebody in the face and say, yeah, this company is going to make 80% a year for the next 5 years. Right? I probably not going to believe you, okay? But the thing with this is, because it was only up 20%, I say only because in context here, one was up 80, another was up 200. The context here is, hey, it might have room to do better, right? In the next year, in 2024, moving into 2025. We'll see if that's going to be the case, but the fact that it hasn't really, quote unquote, taken off compared to what the stock market did last year, I think this has some space and some room to run. So this is the one that might have the best growth potential in the future, even though that discount is very small at this point in time. Next here is D.R. Horton, another company that's in the home building manufacturing space. Their stock symbol rather is DHI. Right now, I am valuing the company at about $170 per share. Right now, it's about $145 a share. This is a relatively good discount, especially when you're looking at the list that I currently have. So this is the one that perhaps has, again, the best discount right now. Obviously, the stock market is changing as you're currently watching this video. Now, when I'm looking at the performance of this company, last 6 months it's up 18%. That's solid. It's up 46% over the last year. So we'll see whether that last year's is really going to matter or not. Up 46% is great that has happened. We'll see what it's going to be in the next year. Again, I am seeing a good, solid trend in manufacturing and home building. This could be the very beginning of that. And a company like D.R. Horton and a company like Clenice, that those two companies perhaps have the most room to grow, but one of those has a better discount than the other. The next one here is not a home building and manufacturing company. It's actually an energy company, Diamondback Energy. Now, I had a big day today. This company was up 5% just today. Just today it was up 5%. And also, for whatever reason, and I just need to do more research here, their stock symbol is FANG, F-A-N-G. Diamondback and FANG don't go together, but whatever, okay? The stock symbol again, F-A-N-G. Now, I'm valuing the company, and I've looked at Morningstar and some other rating services, anywhere between $192 to $200. Okay, $192 to $200 per share is where it is valued at. And right now, it is trading at about $178. Obviously, because it's up 5% today, I wish I would have picked this up yesterday and would have had an even better discount. But that's a pretty big spread. That's a pretty big discount. In the last year, it has been up only 18% in the last 6 months, and up 15% in the last 6 months, and up 16% over last year. So 15 and 16. Again, contextually, right, the stock market was up close to 20-ish%. I think it was like 19 or 20% last year. Okay, that's fine, right? The fact that this was up 16 was one, it was close, but again, if I care about whether or not something can outpace what it did last year, it is easier to outpace 16% versus doing better than 80%. So again, these aren't hard and fast rules. It's just, anchoring bias is what we call it. But I do think it does have room to run. Other stocks that have been in this position have done quite well. Go ahead and look at Constellation Energy. We have talked about that one several times on this channel, and it has done quite well. I think this could be the next one in that space. But with any oil company, with any energy company, but especially oil, know that situation can be volatile based on what country does what and at what time. Okay, so it does have a little bit of a concern, but again, Constellation Energy did quite well. Perhaps this is the next one. Now, here's the other thing. You guys have seen, or if you haven't seen, you're about to, right, where I've taken my money and multiplied it by 4 by choosing what I would consider all the right stocks, right? I've taken NVIDIA, I've bought a few other tech companies that have done quite well, and I think you want to pair these two things together. Get you some value stocks, and perhaps they can do quite well in the long-term future, but also get you some stocks that can do well right now. But what are those stocks? Where are they? And what apps did you use? You want to check out this video next.